Good afternoon, everyone, and welcome to episode 17 of Ask Mortgage Mike, where I take topics and questions regarding the mortgage industry from you, the viewers. I do my best to try to answer those questions for you. So today on episode 17, we're going to discuss the differences in mortgage payments versus the terms. So we're going to look at a 30-year fix, a 25-year, a 20-year, a 15-year fix. We go all the way down to a 10-year term also. But I want you to see the impact of what your payment has versus the overall payment in the mortgage over the life of that loan. Now, most people only hold the mortgages for 4 to 7 years. That's the average. But I want you to see the impact of, if you plan on holding the mortgage long term, what the additional payments can do. So I'm going to start with just a blanket loan scenario here. So we're going to look at a $300,000 loan, and we're going to look at an interest rate of 3.75% on a 30-year fix. Now, this is just a generic. That's not today's rates. That's just, we're looking at that rate so that we can come up with a payment. So the payment on that is $1,411. Now, that's without taxes, without insurance, without anything. That's just principal and interest payment. But what I want to do is I want us to look at that number over a 30-year period. On a $300,000 loan, you would pay $207,856 in interest. So you'd have $300,000 plus the $207,856 that you would pay on top of that, for a total amount of $507,000, just under $508,000. Now that's on a 30-year fixed. If you just drop that down to a 25-year term, you would have to make an additional payment of $131. So the total payment would be $1,542. You'd have a 25-year term, so the loan's paid off 5 years sooner. That would reduce the amount of interest you pay by $45,000. So your total interest paid would be $162,718 would be the total interest paid. That's just by dropping it to a 25-year fixed versus a 30-year fixed. Now, if we drop it all the way down to a 20-year fix, the payment goes up $237, so a total payment of $1,779, but the interest you pay is only $126,880, or a savings of just under $81,000. That's going from a 30-year term to a 20-year term. Now, if you drop it all the way down to a 15-year term, the payment goes up significantly, right? We're talking about cutting the payment in half, but the payment goes up to $2,200, so that's a payment increase of $789 over the original 30-year fixed. However, the principal or the interest that you pay drops by just under $112,000. So the total interest paid is $96,057 over the life of the loan. So you went from what was originally just under $208,000 to just over $96,000 by reducing the amount or the term on the mortgage. The interest rate plays hardly any impact in it. It's the life of the loan that has a big impact on it. So again, just some basic information on how shortening the term can help you save money in the long term. Hope this answers some questions for some people. If you need anything at all, please post in the comment section below, or reach out to me at askmortgagemike@gmail.com. Please subscribe to my channel, and I hope everyone has a great week. Thank you.